How banks actually make money from your money. Imagine you have $10,000. You walk into a bank, deposit it into your savings account, and go home. Where do you think that money goes? Most people imagine something like this. Your $10,000 goes into a giant vault. The bank keeps it safe, and whenever you need it, you simply come back and take it out. But that's not really how modern banking works. Because to a bank, your deposit isn't just money to store. It's also part of how the bank funds its business. And understanding what happens next explains how banks can make billions of dollars. You're not the bank's only customer. Imagine 1 million people each depositing money. $500, $2,000, $10,000, $50,000. Suddenly, enormous amounts of money are flowing into the bank. Customers expect to be able to access their money when they need it, but normally, they don't all withdraw everything at exactly the same time. That allows banks to manage their deposits, cash, reserves, and other funding while making loans and investments. And this is where things get interesting. Let's simplify it. Meet Sarah. Sarah has $10,000 in savings. Her bank pays her 2% interest per year. After 1 year, that's roughly $200 in interest. Sarah is happy. Her money is earning something. But now meet David. David wants to buy a house. He doesn't have enough cash, so he goes to that same bank and asks for a mortgage. The bank approves his loan, but David isn't borrowing at 2%. Imagine his mortgage costs 6%. Now you can start to see the business model. The bank pays relatively low interest to obtain some of its funding and earns higher interest on many of the loans and other interest-earning assets it holds. That difference is extremely important. Banks call a key measure of this business the net interest margin. But there's an important detail. It's not as simple as saying, the bank pays Sarah 2%, charges David 6%, and keeps 4% as pure profit. Banks have expenses: employees, branches, technology, security, regulation, and some borrowers don't repay their loans. So the spread helps generate revenue, but it isn't all profit. And mortgages are only one example. Look around you. Someone wants a car, auto loan. Someone wants to start a restaurant, business loan. Someone uses a credit card and carries a balance, credit card interest. A company needs millions of dollars to expand, corporate lending. Banks can earn interest from many different types of lending. And generally, riskier borrowers are charged higher rates because the bank is taking a greater chance that it won't get all of its money back. Credit cards are especially interesting. Imagine you spend $2,000 on your credit card. If you pay the full statement balance on time, you may avoid interest on those purchases. But if you carry that balance, the interest rate can be much higher than the rate on a typical mortgage. And interest isn't the only potential source of revenue. Banks and card issuers can also earn various fees, while payment networks and other participants can receive portions of the economics surrounding card transactions. So every time millions of people swipe, tap, borrow, and repay, money is moving through a huge financial machine. Then there are fees. Depending on the bank and account, customers might encounter account fees, overdraft fees, ATM fees, wire transfer fees, foreign transaction fees, card-related fees, and banks can offer paid financial services to individuals and businesses. A few dollars might not sound significant, but multiply small amounts across millions of customers and transactions, and they can become substantial revenue. Large banks can have entire businesses that have little resemblance to the neighborhood branch. They may help companies raise money, manage investments for wealthy clients, provide trading and treasury services, process payments, exchange currencies, advise companies on major transactions, manage assets, and provide financial services to huge corporations. So when you hear that a major bank generated billions in revenue, it didn't necessarily come simply from lending out customer deposits. Modern banks can be enormous financial businesses with many different revenue streams. Now comes the scary question. What happens if thousands of customers suddenly say, "Give me my money"? Banks have to manage liquidity carefully because not every dollar of their assets is sitting as physical cash ready for immediate withdrawal. Loans, for example, may be repaid over years. If confidence disappears and huge numbers of customers demand their deposits at once, a bank can face a bank run. That's one reason banking is heavily regulated. Banks maintain liquidity and capital requirements, and many countries have deposit insurance systems designed to protect eligible depositors up to certain limits. So go back to Sarah's $10,000. From Sarah's perspective, it's savings. She sees bank balance, $10,000. But from the bank's perspective, her deposit is also a liability, money the bank owes Sarah. The bank combines deposits with other sources of funding and owns assets such as loans, securities, and cash. Those assets can generate income. The bank pays its funding costs and operating expenses, absorbs losses when borrowers fail to repay, and if everything works properly, what remains contributes to profit. So banks aren't giant vaults that simply charge people to protect their cash. They're intermediaries. They connect savers, borrowers, businesses, investors, and the payment system. Your money enters the banking system and becomes part of a much larger network of lending, investing, and payments. So the next time you look at the number inside your banking app, remember, to you, it's your balance. To the bank, it's part of the engine that keeps the financial system moving.